Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey everybody, welcome back to the Get Real Podcast. Ron Phillips here. And this is the first podcast I've done since the massive hurricanes. And my heart goes out to everybody who's been affected by those. I've had a lot of friends who live in Florida, and I have a few friends who live in North Carolina and the affected areas. And the stories of the devastation in those areas is it's dramatic. As a matter of fact, I was at dinner the other night with my wife, and we met a family who was displaced from Asheville, North Carolina. And I was talking to them a little bit about, what it's like up there and everything. And they said, whatever you imagine in your mind, it's worse than that. So man, really, really feel for them, really feel for everybody who's been in the path of either one of these storms. And really hope that that we don't have any more this year. Although we very well may, which leads me to some things. I've been talking to a lot of people who are really concerned about insurance, and rightfully so. Look, insurance has it's skyrocketed really over the last several years, for a host of reasons. Not the least of which, however, is that insurance companies pay when things get destroyed. And, we've just had massive destruction on a scale that most of you listening and me have never experienced in our lives. And so, this will definitely have impact on, the insurance rates. It just will. Now, it will have an impact on insurance rates in Florida and North Carolina, to be certain, Georgia to some degree as well. But it will have impact further than that, and that is because there are a few ways that insurance is structured, and one of those ways that insurance is structured is that it's in pools, and depending upon how weighted that pool was with properties in the storm's path, it could have major implications on the pool that your insurance is in, for instance. And so I don't want to spend an enormous amount of time talking about insurance and how it works, because I'm not an expert on how insurance works. However, there are a few things that I can tell you that might help you guys out. Shopping insurance is a necessity today. So whether it's your investment portfolio or if it's your personal, shopping insurance is mission critical. And the reason for that is because all insurance companies are not created equal, not on payout and not on premium. And so super, super important that you're constantly looking at your insurance, especially when you get massive increases, and get out and shop it. However, make sure that you look at whether or not the insurance companies pay, because I can tell you from personal experience that, if an insurance company doesn't have a good track record of paying out on claims, that you're going to have to fight with them to get money, which in some cases is worse, in many cases is worse than the increased premium that you might have to pay. So make sure you check on that. But for sure, there are insurance companies that will pull out of Florida because their pools, because they have to recoup the losses elsewhere, and they don't want to take any more risk in an area that has kind of kicked their butts. Other insurance companies who haven't had those losses will go into Florida and they'll pick up insurance, and they'll take their chances. They'll work on their risk pools and they'll take their chances. So if you have properties in Florida, for sure, your rates are going to go up. But if you don't have properties in Florida, your rates might go up anyway, and then you should shop. Which leads me to the next thing I want to talk about, which is if you own, I was just talking to 2 or 3 of my friends who have larger portfolios. I think for the most people, they would be larger portfolios, north of 25, 50 homes, some of them north of 100 homes, and they don't have a master insurance policy. If you have a substantial amount of properties, you should seriously consider looking into a master insurance policy. And that policy is, we have a master insurance policy. All of our clients, investors get to use that policy for properties that they purchase from us. That's an important distinction because one of the main things about the master insurance policy is that it has loss ratios of its own. The pricing on it is adjusted based on what happens with the loss ratios inside of that pool. So ours happens to be a very high performing policy. It has very low loss ratios, and it's one of the better performing, if not the best performing portfolio that insurer has. And it's because we're super selective about the properties that we put in it. So if you live in an area and you have a large amount of properties, you should look into having, especially if it's in an area that is not super storm prone, like there's not a whole lot of damage that happens to properties. You might be very well suited for this type of policy. It takes all of your policies and puts them into one policy, and then that policy is priced out based on how well the policy performs. Ours performs really well. So when everybody else has had these massive increases over the last few years, we've not experienced those, and that's really, really important. It makes it so that cash flow for our clients is easier to achieve because they don't have this massive insurance expense that a lot of people out there, if you're just shopping, your normal insurance carriers have. So master insurance policy could be really, really important for you. Now, the reason why we're really choosy about which properties go in it is because of what I just told you. If we let everybody in, it would mess up the pool. Welcome to my truck, guys. I am recording from my truck. And some of you guys might not know about this about me, but I am Sammy Hagar and I are friends. I have a hard time driving 55 or any speed limit, except for, in, housing areas where, residential areas. I always go speed limit or below the speed limit in residential areas. But other than that, on the highway, I am a little bit lead footed. So my car has a built-in radar detector and laser jammer. And I highly recommend for anybody who has lead foot. It's called I think it's called a K50. It's really, really good. I muted it, so that will not happen again. But we're really choosy about what we put in because it will mess up the pool if we put a whole bunch of properties in there that are at high risk. So we don't let even our clients, we don't let them just go buy properties from wherever they want and put them on our policy. We have a pretty rigid underwriting process that we follow for those properties. And that's because we really, really watch our loss ratios. And because we want to keep it really, really, we want to keep them really, really low because, again, it makes a dramatic difference on the cash flow for our clients. And it's one of the competitive advantages that we have from anybody else who does what we do is our insurance is so inexpensive compared to everything else out in the market. Now, the other thing I wanted to touch on today is in talking to some of these friends who have similar pools of properties that they've continued to buy over the last several years. They have interest rates that are, 7s to 8s because they've been, buying these properties over the last couple of years when the rates were really high, and they're, most of these guys are buying them from and financing them from local banks, et cetera, and they have really, really high rates. At some point, you hit a cap with Fannie Mae and you can't buy any more Fannie Mae loaned properties. And at that point, you have to look elsewhere. Enter the DSCR loan. I know that we have talked about DSCR loans in the past on the show. However, interest rates for DSCR loans right now are really attractive. And for those of you who are new listeners, you have no idea what I'm talking about. This is called a debt service coverage ratio loan. In other words, you personally, other than your credit score, you don't qualify for the loan. They don't care about your job or your assets or anything else. They care about whether the property can sufficiently cover the debt service. That's it. And they do that by a ratio. Ratio may be 1.05, it may be 1.25. They're all different. But if you meet or exceed that ratio, then the loan is approved. Now, it was in the past that those were substantially higher than a traditional conventional loan, that would be sold on the secondary market and is highly regulated. Well, that is no longer the case. They are very similar. At some points in time, DSCR loans are actually less expensive than conventional, and they're far easier, regardless of the pricing. They're far easier to get because it's all about the numbers. And anybody out there who has been concerned about whether or not, a property makes sense and can you believe the person that's selling it to you and all of these things, well, a DSCR loan is a really great counterbalance because not only are they going to appraise the property like any lender would, but they're also going to run the numbers for you, and they're going to run them based on their internal calculations about how properties over time have performed, and they're going to put it into their model. And if it works in their model, then it's likely going to work. Otherwise, they wouldn't have done the loan. They're a really unique product and they're becoming very, very popular. So if you have a substantial number of properties, they do blanket loans where you can go out and you can get a group of them DSCR loan for your properties and have a loan. You can refinance any of your properties and do that. So a lot of my friends who had these higher rates, 8.5%, have been refinancing to 6%, just a little bit over 6%. DSCR loans, and they didn't know they could do that until we were talking about that and the insurance. So I bring this up because your expenses on your properties are going to go up now because of insurance. Understanding the levers that move the finances in your investment property business is going to become critical. So if you're buying investment properties, you need to make sure you understand the insurance cost. You need to make sure you understand the taxes. Make sure that the taxes are not calculated on the previous year and you're going to get it reassessed at a really high rate. And then your taxes are going to go up because likely your insurance is going to go up. You just need to be really diligent is the word, right? So cautious is a good word, but sometimes cautious folks never make any decisions, and for that they don't ever actually move forward, which is a shame. But diligence is a good thing. All right. So insurance, master insurance, lending. There is debt service coverage ratio loans, and they're really attractive right now. So I encourage you to look into both of those things. Last thing, and I know I said this a few podcasts ago, but I'm going to say it again because every single year, we have people who call us December 15th looking to finance a property before the end of the year because their accountant told them that they need a write-off. And I've been banging the drum now for weeks that if that's you, if you need a property, go ask your CPA now. Don't wait. Go ask your CPA now. If you need one, or two, or three, or four, or whatever the number is, let's do it now before it becomes I mean, December 15th, folks, it's too late. It's not going to get done unless you want to pay cash, in which case we could probably get it done. And even then, everybody starts to go on vacation. So please, for the love, if you need properties and you want to buy properties before the year is over, you need to start looking right now. Reach out to us, invest@rpcinvest.com, invest@rpcinvest.com. Looking forward to hearing from you. Again, if you have any ideas about the show, anything that we could talk about on the show, let me know. Happy to do it. And until next week, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.